Welcome to the final video in our series on sources of finance. In this video, we will be taking a brief look at different debt, equity, and hybrid instruments which we can use to finance our business. What are our learning objectives for this video? First, we want to identify and discuss different types of equity, debt, and hybrid instruments. We also want to look at some of the different features of these instruments and what they mean. Then, we want to compare debt and equity instruments. We need to understand the differences between them to make an informed decision on how to finance our company or project. Our equity instruments are the primary source of finance for a business that are supplied by the owners of the business. In the case of a company, it will take the form of ordinary shares and retained earnings. So what is an ordinary share? An ordinary share represents a person's ownership in a company. The owner's wealth is affected by both the capital appreciation on the share, represented by the change in the share price, and the dividend it pays. Because a shareholder carries more risk than other forms of financing, the return expected by the shareholder is greater. To raise more finance through ordinary shares, we simply issue new shares to the public, subject to any stipulations in the Companies Act or the Memorandum of Incorporation. Retained earnings is simply the profits that have not been distributed to the shareholders. Profit generated through the operations of the company can be kept in the company to fund its future growth. The cost of retained earnings is the same as the cost of the ordinary shares because the shareholders are foregoing their dividends in the expectation of future growth. If we look at debt, it can really take a number of forms. We could have bonds, notes, debentures, mortgage loans, bank loans, and so forth. There are a number of useful classifications we can think through with regards to debt. First, we have the loan term. Debt can be short-term, medium-term, or long-term. Short-term debt would normally be things like bank overdrafts and credit facilities, which do not form part of the permanent capital structure. Medium-term loans are generally between 1 year to around 10 years, while long-term loans would be for periods in excess of 10 years. Another useful classification is the interest rate. It can be either fixed or variable. A fixed interest rate loan has an interest rate that does not change across the period of the loan. A variable or floating interest rate is an interest rate that is fixed to a specific benchmark, such as the JIBAR or similar. As the underlying benchmark fluctuates, so the interest rate will increase or decrease accordingly. Finally, we get secured or unsecured loans. A secured loan has a preferential claim over one or more specified assets within the business. Thus, if the company defaults, the loan issuer will be able to attach those assets. Unsecured debt has no such preferential claim and is therefore considered riskier. Remember, a riskier loan will have a higher interest rate. If we consider how debt and equity relate to each other, we can consider them on a spectrum. Pure debt and pure equity are on the opposite extremes. Hybrid instruments then fall in between these extremes. They can be mostly equity and a little debt, or they could be mostly debt and a little equity, or they could be equal amounts of debt and equity. With this understanding, we can answer the question, what is a hybrid instrument? It is an instrument that combines aspects of both debt and equity. They could also combine aspects of the spot and derivative markets. They are particularly useful because they can be constructed to suit the specific needs of the financing situation. So once we have identified an instrument as being hybrid, how do we go about classifying it as debt or equity, knowing that it contains elements of both? This is a very challenging process, and some guidance can be provided. First, we want to consider whether the instrument has a residual or contractual right to the profits of the company. If it is a residual right, then it is more likely to be equity, but if it is a contractual right, then it is more likely to be debt. We then need to consider if the payments are tax deductible. Interest payments are tax deductible and may indicate that we are dealing with a debt instrument, while dividend payments are not tax deductible and may indicate that we have an equity instrument. We can then look at the life of the instrument. If it is finite, then it is more likely to represent debt, while if it is indefinite, then it is more likely to represent equity. Finally, we need to ask ourselves if the instrument gives the holder control over the company or not. If it does, then it is more likely to be equity. If it does not, it is more likely debt. Remember that these are just some considerations that may help in the classification process. In terms of the international accounting standards, we typically split the instrument into its debt and equity components and disclose these separately. One of the most well-known types of hybrid instruments are preference shares. Like debt, preference shares typically promise a fixed dividend. However, like equity, the dividend may be passed if the company has insufficient money and the dividends are not tax deductible. Let us look at some of the different issues surrounding preference shares, which will also affect whether they would be classified as debt or equity. First, we have cumulative and non-cumulative preference shares. Unless specifically stated, preference shares are generally assumed to be cumulative. Cumulative preference shares have a right to an arrear dividend. The arrear dividend accumulates until they are paid. If the dividends are in arrears, the preference shareholders will get voting rights and can therefore exercise some control over the company. Next, we have participating preference shares. In addition to their fixed dividend, these shares also participate or share in the remaining profits of the company in some predefined proportion. Redeemable preference shares are those preference shares that have a fixed life. The company will redeem them or buy them back at a specified price on a given future day. Finally, we have convertible preference shares. These are preference shares that the holder has a right to change into either ordinary shares or possibly some other instrument in the future. Let us end this video by comparing debt and equity. There are three key pillars on which to compare them, namely risk, return, and control. If we begin with risk, we see that there's a commitment to pay the interest on debt. This interest must be paid whether or not the company has made a profit. Dividends, on the other hand, can be passed if the company cannot afford to pay them. In addition to the interest payment, the debt capital also needs to be repaid. This again may place strain on the company. Equity, on the other hand, does not need to be repaid. Regarding capital structure, there is a limit to the amount of debt that can be raised before the market reassesses the company's risk level. At this point, the cost of equity will increase as the risk of investing in the company also increases. Likewise, once debt gets to a saturation point, nobody will be willing to provide debt to the company anymore. Finally, we need to consider the signaling effects of issuing debt or equity. An issue of equity is normally associated as a negative signal that the current market price is too high and the shares are overvalued. Moving on to the pillar of return, we see that debt requires a fixed interest payment. This can be beneficial if the company is doing well and our return on assets is greater than the interest rate. This is known as positive gearing. However, the reverse will be true if our company is struggling and the return on assets is less than the interest rate. This is known as negative gearing. We also need to consider the tax consequences. Interest payments are normally tax deductible, while dividend payments are not. Finally, we need to look at the cost of debt and equity. Debt is normally cheaper than equity. This is because of the lower risk, as it has a contractual rather than residual right. It also has cheaper issue costs and is tax deductible. Finally, we can look at the pillar of control. Issuing new shares dilutes the control of the existing shareholders if they are unable to take up the new shares in their current proportions. Debt can also have some control implications, but these are not as severe. Certain restrictions or loan covenants may need to be adhered to for debt. This brings us to the end of our series on sources of finance. Thank you for joining us, and be sure to check out our other series.